So let's begin with the big issue. Markets looking for signs of a trade deal heading into the G20.
Everybody's waiting for the G20.
The G20.
The G20.
The G20.
The G20 is not going to be positive for risk.
Don't expect a trade agreement this week.
We're not really pricing in a major event.
The best that you can hope for from the G20 is there's a reset.
This is not going to be a one and done.
We probably will end up with a standstill agreement.
What we are looking for is to see progress in terms of the negotiations.
Whether or not the tariffs on China will be delayed.
We don't see an escalation in terms of expansion of tariffs.
As long as there's not a lot more negative news, we think that that will be constructive.
But if things go badly wrong, we could be panicking, I think, on Monday.
So the key question, are investors too optimistic or pessimistic about the odds of a deal getting done? Joining me now around the table, Bill Zox of Diamond Hill Investment Group, Stephen Parker of JPMorgan Private Bank, and Hyzy of Bank of America, Merrill Lynch Private Bank. Stephen, I want to start with you. We did see an initial reaction after Mnuchin made some comments about the idea that there would be some sort of deal. Then President Trump came out saying that perhaps he should sue some of the big tech companies. All was lost. How does one price this?
I think you have to recognize what you can and can't anticipate as an investor, and trying to predict the outcome of trade wars is just not something we're in the business of doing. Let's keep in mind the 90% number that Mnuchin threw out there this morning was the same number that was thrown out in April and May before things kind of fell apart. As we heard in the intro, I think the best case scenario for this weekend is probably just a reset and hopefully a re-engagement rather than an escalation in tensions. That's our base case, but we're not making any huge shifts based on that.
Okay, so let's say that's the case, Chris. No escalation, no resolution. How much do stocks gain?
Stocks gain quite a bit over the next 6 months, but all eyes are more on the Fed than there really is on the trade negotiations. We talk about the G20 a lot. It's really the G2 within the G20. And when you step back for a second, this is a really long, drawn out years of negotiations that's going to go on. The most important thing is what Stephen said, which is no new escalation of tariffs or no new expansion of tariffs. Once that gets put out there this weekend, the shift will go back to the Fed again and earnings season. So if you focus on that, I think you've got reflationary tendencies going on right now. The stock market outside the U.S. is telling us that, the dollar's telling us that, and gold's telling us.
So, Bill, question, if there is some sort of easing of the trade tensions, talking about the Federal Reserve, does that mean that they will be less inclined to cut rates as much as the markets are hoping for?
Well, I mean, to this point this year, the Fed has given everything the markets asked for and more. So I think that the Fed is still really just following the markets, and the markets are pricing in 3 rate cuts right now. If the markets pull back some of those rate cuts, I think the Fed will follow.
So, I mean, in other words, if the Fed's the most important player here, and the Fed is going to cut rates regardless of any sort of resolution in trade agreements, the market has a backstop, period, end of story. Stephen, do you agree?
That seems to be what investors are anticipating. I think what you have to look at is the markets thus far have made a clear delineation between what they perceive as trade war winners and losers. And I think that where you may see the biggest pop from a risk asset perspective is in some of the parts of the market, emerging markets, semiconductors, things that have underperformed because of these trade tensions. If we get that sort of detente and the Fed is on hold, that's a really good environment for those types of names.